Just all right, we're going to get this started. Thanks everyone for being on this first webinar. I'm excited to be able to get these going. My hope is to, bring some education, talk about current markets, and explain some things that have been going on so you can kind of stay educated. We're also just going to have different topics every month. So we're going to try to do this on the first Tuesday of every month at this time. They will always be recorded, so you can check them later on as well. So don't worry about like taking notes or anything like that. You can always, get the replay and review something if you need to. If you do have questions throughout it, go ahead and just send me an email and I'll get back to your questions then. Just so we can, get through it, all of this today. I want to be sensitive of your guys' time as well and just kind of get through what we have today. And then, we can deal with any questions after that. So, today we're just going to talk about being a confident investor in times of chaos. There has been a lot going on in the markets the last year. And so just want to kind of get through some of those and just, build that confidence in, as you learn more, as you continue being educated, just to have more confidence as an investor when these times of chaos do arise. So let's move into it. So who is Selah? Sorry, I'm trying to find out where I want to keep this, but Selah is the company I started. It's been almost 4 years. It's 4 years ago this summer, which is crazy, in 2019, with the goal of bringing confidence and organization to people's financial life through education, stewardship, and empowering wise decision making. We're a wealth management planning firm located in California, but serving clients nationwide. I do not set minimums. I know everybody is always getting started somewhere, and I love to come alongside clients and just help them with their finances wherever they are at. So the goal of today is to help you become a more confident investor. I want that for you. You do that in a few different ways. So one, we're gonna have a better understanding of the current markets, and two, we want to recognize common emotions and impulses related to market volatility, and three, just to see how markets and emotions affect portfolios and remain focused on long-term goals, which is a lot easier said than done, I know. But hopefully after today and after talking through some of these things, you'll have a better feeling there. So market update. There's always a lot going on. Just especially this last year, there's always different headlines. Today, we're going to focus on bank failures and trouble. I want to talk more about that and kind of teach you what was happening with banks. We're going to talk about inflation, and we're going to talk about recession, possible impending recession. So first, let's take a quick look at just where the market is. So we had a bear market that began, technically it started in January of last year. That's when the market first started going down. It was confirmed later in the year, but bear market that began in 2022. A bear market is a fall, so a fall in the market from its high of 20% or more. So this market went down more than 20%. That confirms a bear market. We won't come out of a bear market until that reverses, until we have a 20% gain off its low. That's when we know we're out of a bear market. So we don't really know when we've hit that low in a bear market until we've actually reversed and gone in the direction, and we can look back and say, okay, that was the low. The S&P 500, which is a 500 companies encompass the S&P 500. Was down 25% at its low, and its low happened in the fall. So like September of last year was when we hit that low. So far we hit a low in June and then hit a new low in the fall of 25%. Currently we're still sitting 14% off its high as of yesterday. The Dow Jones hit a low, same in the fall, about September, about 21%, and currently we're sitting 9% off its high. So if you look on the chart to the right here, you see, up here, the stock index performance, here, sector performance, and then some fixed income and commodities in this lower chart. This is a lot more green than we have seen in the last few charts recently. So that's nice. We get to see a little bit more green. Always a positive thing, but you can see, so the S&P, this is the chart as of last Friday. So as of March 31st, last Friday. S&P week ending 3.48%, 1 month 3.51%, and then year to date this growth of 7.48%. Dow Jones Industrial, you see that there, and then the NASDAQ, you'll notice, okay, that's a much higher number, which we, to explain that further, if you look down here in this sector index as well, you also see this higher number here with information technology. The NASDAQ is a very tech heavy, and tech was hit the hardest last year, and the NASDAQ went down further than what I've listed here for the S&P and the Dow. So it's come back a little bit more so far this year. So that's where you see those bigger numbers there with the NASDAQ and technology down there in that sector, the sector section right here. So that kind of just gives you just to give you an outlook of where this currently stands. We like I said, the bear market lasts an average of 12 months. We're over that right now. We have not, and we won't know when we've come out of that, like I said, till it reverses. So we're still kind of waiting to see when we can, get out of this bear market. So what happened with banks? That's obviously been the headlines the last few weeks. And I wanted to explain to you guys kind of what the situation with banks was, what happened on the back end to start causing this bank crisis, or what could be perceived as a possible crisis. So it started with Silicon Valley Bank a few weeks ago and Signature Bank. So you had the prices of Silicon Valley Bank, stock prices were going down. And then over the weekend, it had failed, and then Signature Bank had failed. And it was like, okay, well, what does this mean? Great, this feels like 2008 again. Is this 2008 again? It was a big deal. Silicon Valley Bank was the biggest bank failure since Washington Mutual in 2008. And so it's a big deal. It's a big headline. And there was different solutions. So you had the first three, Silicon Valley, Signature, and First Republic. They had similar issues. Credit Suisse is a different issue, and I'll talk about that one at the end. But I want to go through the first three and just what the issues were there for those three and what happened. So here you have this chart up here, and it's showing you the Treasury security, prices, this drop in this Treasury security price, this blue line, and then these unrealized losses are this orange line. So to step it back just a little bit further, I want to just explain bond prices and bond yields to you. So a bond, you're lending your money to somebody, par for a bond is $100. You're lending it at par, you give them $100. You have a interest rate they are paying you for that bond over a period of time called the yield. And that is how bonds work. And then there are different lengths of time. So when you have a bond, let's say you purchased a bond a few years ago, interest rates were lower, your bond yield was 3%. You have a bond, you put in, par was again $100, you bought this bond, or you're loaning your $100 out for this bond, you're getting paid a 3% yield over time until it matures and you get your $100 back. Well, when interest rates go up, bond prices go down, meaning your bond, say you need the money, you can't wait till maturity, till your bond matures to get your $100 back. You need to sell that on the open market, but you have a 3% interest rate, and interest rates are now at 6%. No one's going to buy your bond for full price. The price of your bond is now it has to be sold at a discount in order to sell your bond. And so you lose money. So that is essentially what happened to Silicon Valley, Signature, First Republic. They, on their balance sheet, like all banks, when you put your money in a bank, it does not stay in the bank. The bank is loaning it out in different ways. There are different mortgages or auto loans or business loans, or in this situation, this investment for these banks, they owned a lot of Treasury securities. And what happened was as interest rates have gone up, like I was just explaining, they have these Treasury securities that they own, and they will mature at par, meaning they will mature at what they paid for it, that $100. But if they have to liquidate it early, they have to sell it at a loss. And so when there was a run on the bank, when people kind of started realizing, okay, maybe Silicon Valley is having liquidity issues, they didn't have enough money to cover the people needing deposits out, then Silicon Valley Bank is having to go sell some funds sell their bonds, these treasury securities at a discount in order to try to cover the withdrawals that were needed from the bank. Except they can't, because now they're selling at a discount. So that was part of the issue that was happening. The other side for Silicon Valley specifically is that they are also heavy tech consumer base. And like I already mentioned, tech got hit really hard last year. And so, the other perfect storm for Silicon Valley was that these companies are needing to pull out more money than they're not making enough money, just keep putting money in the bank. They're needing to pull out more of their, reserves in order to cover payroll and those sort of things for their businesses. That deposits were not, withdrawals were greater than deposits anyway. So they kind of had this perfect storm situation that, got out to Twitter, trended on Twitter. People started getting nervous and wanted to go pull out their money. And then, as we know, if there's a run on the bank, then that causes all sorts of issues because not all of everybody's money is there. So then you had the FDIC step in, the government stepped in, and by the end of that weekend on Sunday, they had said, before the stock market opened on Monday, we are going to cover all deposits, normal insurance is up to 250,000. They stepped in and said, we're going to cover all deposits greater than 250,000. We're going to cover all deposits that people had in Silicon Valley and Signature Bank to make sure to essentially keep consumer confidence in banks high. Because the last thing that this economy needed and the government wanted was consumers to be now not trusting banks and wanting to go pull their money out of the bank, which would cause a whole crisis. And so they said they would cover deposits, full deposits for those people that had accounts there. That was Silicon Valley and Signature. That was the solution that was come up for those two. First Republic looked a little different. JP Morgan, the government actually talked to JP Morgan Chase, and JP Morgan Chase rallied a total of 11 banks to infuse $30 billion into First Republic Bank to help cover their deposits. And then, like I said, Credit Suisse had a different issue, and it was not related to interest rate rising situation. They actually had correct hedging against the raising of interest rates. They were doing well there. They kind of had more of a situation of bad timing. Credit Suisse has had its problems. They've had plenty of problems, but they had, after all this happened, then their biggest backer, the Saudi National Bank, made comments saying that they would put like a 10% stake into, or just shy of 10% stake into Credit Suisse last year. And they came out and said they were no longer going to back Credit Suisse. They weren't going to put any more money in. And so that made obviously those consumers nervous of why. We're already seeing all these other banking headlines. What's going on with Credit Suisse? Is this one failing too? And it just caused their share prices to plummet, in which UBS was able to step in and purchase them. So in a sense, that's kind of what has happened with the banking situation. Now, seems like recently that has subsided a bit, that those solutions that were used for all of these have done a decent job of keeping consumer confidence in banking higher. And that was the main thing. The government wanted consumer confidence in banking to stay high, to make sure people were not running to banks to pull their money out, because that just causes widespread panic and problems. And it seems to have lessened that pressure so far. But that's the situation of how that happened, and the situation that banks got themselves in there. So again, with banking, and because of the headlines of 2008, it was like, okay, so are we back to another 2008? Is that what's happening again here? So this is the financial stress index chart, and basically the financial stress index measures financial stress on the economy, and it does it through 5 different indicators like credit and valuations and safe assets, etc. There's a couple more. It has this formula in which it measures it. So you can see in 2008, here's the financial stress index was much higher. Some blips here, and then you see COVID, obviously much more of a financial stress than where we're at right now. So this has caused a little bit of stress, but it's not near where we are even just during COVID, but definitely not yet to like 2008. So This has stayed relatively, this financial stress index, which is something that is looked at to just view financial stress on the economy, has stayed relatively low, which isn't really giving, too many 2008 vibes. So again, something else to point out, in 2008, there was defaulting on credit. So there was defaults on the mortgage security. So that was more issue. It wasn't right now with banking. There's not defaulting happening. These bonds still hold their value at par. They just have to be sold at a discount now if they need to be liquidated. And so if banks were over, too much on their balance sheet, too many securities, that was a problem. They didn't hedge correctly, but they're not defaulting. So that's the difference between now and 2008. In 2008, their mortgage loans were being defaulted on, which made a whole different scenario. So this was obviously, the bank situation was caused by the raising of interest rates. So that's what put the banks in this kind of situation. They obviously did not manage their investments well, but their investments were put in this situation because interest rates were being raised. So, then we have to kind of like look at inflation. Is inflation getting better? What is happening there with inflation? So here's an inflation dashboard. We're going to pay more attention to CPI, Consumer Price Index. That's the main inflation reading that the analysts and professionals and the economy and the government, that everybody monitors when looking at inflation. There's obviously other ways of reading it here, but we're going to focus on that CPI, Consumer Price Index, which is the cost of a basket of goods or services year over year. So the cost of a basket of goods in March of last year versus March of this year. What is that number? February of last year, February of this year. And you can see over summer of last year, we hit really high numbers of just shy of 9% June year over year. So from June 2021 to June 2022, there's inflation of 9%. Just shy of 9%. July year over year, 8.41. So you can see this was slowly trending down, but slowly. The Fed was hoping this would trend down quicker. It's been a slow process. And that's because, there are other factors, like we know with everything shut off during COVID. And then we've all heard supply chain issues, and then pent up demand and all these other things that have led geopolitical issues, which cause, oil prices to have problems. This all has led to this very slow lowering of inflation. You do see the downward trending, which is good, but is it quick enough? When is the Fed gonna basically slow their roll on raising interest rates in order to help curb this? This is I want to give you guys this inflation chart so you can see that there. So how do interest rates affect inflation? So I wanted to, as we're talking about, the Fed was raising interest rates last year to help, basically bring down that number. It's happening slower than they wanted to. I want to be sure that everybody understands how interest rates affect inflation. And so, just want to, get into some of this information. So the Federal Reserve, the Fed, you've obviously heard that, they control the federal funds rate. The federal funds rate is the overnight rate that banks charge each other to borrow money. So in banking regulation, there is a certain amount of, and I don't know all the exact details, but there's a certain regulation that they need to hold of deposits every night on their books. And so if they are short at night, they can borrow money from other banks overnight. And so the Federal Reserve the Fed is setting that Fed funds rate. That banks charge each other for that overnight borrowing. So that is like the base rate that we have. And then that base interest rate then sets the tone for other interest rates on top of that. If this is what banks are charging each other to borrow that money, then of course they're going to charge more than that to lend money out to you for your car or your house or your business or your credit card, etc. So that's that base rate, and then everything else builds on top of that. So when you hear the federal fund is raising interest rates, they're just raising that federal funds rate. The federal funds rate was 0 during COVID, and it is now, after their last interest rate hike, it is now at 5%. So you can see that mortgage rates hit a low in December of 2020 of 2.68%. And then now they say it's fluctuated. Obviously it fluctuates, and it went down a little bit with the banking information stuff going on, but around 7%, 7.35% in that range. So you can see that when that federal funds rate is raised, how it affects, mortgage rates over time. So when the Fed is raising interest rates, they're trying to slow down the borrowing of money. With COVID, they put it to zero so that people would borrow money and they would start businesses. They would buy houses. They would buy cars. They would put things on their credit card. They want people to start spending money. So they put that federal funds rate to zero. Now it's the opposite. So that caused, they need to slow things down. So they raise the interest rates, which means less people are going to be borrowing money. It slows down that economy. They want the economy to cool off. You've heard, is this going to be a soft landing? Basically, like likening to an airplane coming in. Are we going to have like a nice smooth landing? This is just really easy into being able to lower inflation, doesn't cause a recession, don't have major bumps along the road, or is this going to be a soft-ish landing, or is this going to be a crash landing? So basically they're trying to raise interest rates. They know a recession is a possibility from raising interest rates, but that is a better possibility than an overheated economy where things become too expensive and wages don't rise enough and people can't afford anything. So when we have interest rates that are rising, we normally have volatile markets. And like I already mentioned kind of a couple slides ago, that the average bear market lasts 12 months. I wanted to show you guys this chart, and we are going to, obviously explain it. This is a bear market chart that is showing every bear market from 1950 to current. The S&P 500 change that it had, and the months that it lasted. You can obviously see, some bigger ones, 2000 to 2002, we had 2007, 2009 financial crisis, down 56.8%, lasted 17 months. So the shortest one we had was COVID. That was the shortest bear market. You had from February 19th of 2020 to March 23rd of 2020, hit that low of 33.9%, 1.1 month, and then it started reversing. So this chart is a little bit is a little bit older. This should have a different low. Shows this last bear market that we starting in January 3rd of last year, with this June 13th low. That was the first low, and then we know we hit a newer low. I told you the S&P about 25% in September, and so we don't know, like, this has the asterisk next to it because this has not bottomed yet. So we don't know this. We know this is not the bottom, so the September date should be on there, but we don't know if that September date is the bottom yet. I just wanted to show you, though, it's important to keep perspective that though we don't know if this is, if that September date was the bottom of this bear market, we do know that bear markets only last so long, and they are short relative to bull markets. And so it's just important to keep that perspective when you're in them. So we've been in this for 12 months. We've been in this for longer than 12 months. They don't last necessarily very long. Like I said, 12 months is that average, 11, 12 months is that average. So we do know we're going to come out of it. We are going to come out of it at some point. This is just to kind of help you kind of keep that perspective. When interest rates are rising, obviously last year, that bear market from interest rates, geopolitical tension, were things that caused us to go into this bear market. And now it's looking at, okay, is there a recession on the horizon? A recession would extend the length of this bear market for sure, and maybe cause it to go a little bit deeper, and that's where we won't really probably come out of this bear market until we can rule out that recession. And so that's kind of where we currently stand right now, and that's where you see all that volatility in the market as it's trying to assess what's coming. So if a recession is impending, if we do move into a recession, and to define a recession, well, I'll back it up even further. There were people that felt last year like, well, we did go into a recession. We had 2 consecutive quarters of shrinking GDP. Isn't that a recession? Yes, that is part of the definition of a recession. The other part is always looking at unemployment, and that is the part that we did not have last year. So we did not have high unemployment that went along with those shrinking quarters of GDP. So that's kind of still what we're looking for. You have seen layoffs are definitely more in the headlines than they were, especially in tech. That was, been a lot of layoffs there. And so, if that recession is coming in 2023, as some experts believe that it is, what should you be doing to prepare for a recession? So, a lot of this is so much of finance and financial behavior is just a mindset, right? Recessions are always thought of like it's scary. There's a recession coming. Oh no, most people's first instinct is just to sell their investments. That should not be how you're preparing for a recession. So I would give you these 4 things to do to prepare for a possible recession. Like, look at your emergency fund. Make sure your emergency fund is correctly funded and accessible, and consider adding a few more months worth of savings. So if you have 3 months in there, consider boosting it to 6 or 9 or 12, whatever makes you feel a little bit more comfortable if there is a recession that we enter. Budgeting is always important. Same with emergency fund. Budgeting is always important, but do a budget refresh and maybe make some cuts. Cut some expenses, or if you can't cut some expenses, at least flag some expenses that you can cut. If you go into a recession, you can be like, hey, this one, if we do go there, we know we can save money by cutting this and cutting this and cutting this. So, do a little budget refresh. Possible ways of extra income. So, in case of layoff, or if you just want to provide like another side income for you and your family, look for other ways or other possibilities of jobs you may want to look for in case you do get laid off, or if you just need to make extra money because things that get expensive. And then cash and investing. So recessions are full of opportunity. And it can be really helpful to have extra cash on hand to take advantage of that opportunity. So if you don't have cash on hand, you're not going to be able to take advantage. So during a recession, cash is always king, but especially in a recession, you could possibly take advantage of real estate. You could take advantage of the share prices in your investments, or just other large purchases like cars and furniture. If you have cash on hand, you can normally take advantage of the opportunity that a recession will provide. So I encourage you, along with your emergency fund and getting that extra cash stashed, to think about keeping some cash on hand for opportunity as well. So I showed you that chart about the bear market. We've been talking, interest rates, inflation, bear markets, recessions, lots of negativity. Again, to keep your perspective around just all of this, I wanted to show you this bull market chart. So a bull market, opposite of a bear market, a bull market is a raise off its low of 20% or more. So when the market goes up more than 20% from its low, that's a new bull market. So you see this bull market, all these bull markets listed here. You will notice 2 things as compared to that bear market chart. The gains are a whole lot more than the losses, and the months that they last are a whole lot longer than the months that a bear market lasts. So again, to kind of just help you keep your perspective, that bear markets and recessions are both necessary and normal parts of the economic cycle. And afterwards come a new bull market. And so right around the corner, there is a new time of growth. There is a new time that markets reach all new highs and keep going up. And that is a good thing. So you'll notice 2009 to 2020, that was the longest bull market we have ever had. So that went from the financial crisis, and that ended with COVID. So COVID shut that one down, but it had gained of 400% during that time. And it lasted 131.5 months, a really long time and a whole lot of growth. This is where you see a really short one. So after COVID, so, here was like where the bear market started. Here's where the bear market ended, 3/23/2020 until January 3rd of last year, where we entered a new bear market. It was really short. It was a very quick bull market. So there's a lot of people that think when we get to the other side of this bear market, we actually probably have a good amount of growth and a good length of growth relief on the other end, because the last bull market was so quick. So again, to give you that perspective and to help you keep in mind, like, bear markets are painful. It is painful when you see that value on paper drop in your accounts, but you know that on the other side of that, that is a short period of time, and there is a bull market on the other side. This also is kind of showing you, if you can, like I said, recessions bring opportunity. So if there's opportunity in putting money into the market at these lower share prices, and this growth is on the other side, that's, longevity, this growth is a long time, then it's a really good time to, if you have extra money, to be putting money in the market and dollar cost averaging in the market. This is another chart just to give you more perspective. Again, I just all about creating perspective with you today of with all this chaos, making sure you keep the right perspective with investing. So this chart, people call it the most important chart to ever see when it comes to investing. You have these blue lines. The blue lines are the S&P 500 returns. These diamonds are the max pullback in that exact same year. So every year you can see you have these positive returns on the market, obviously some negative, but this negative did not go as far back as the max pullback that in that same exact year. So every year there is an average of a pullback of about 14.2% every single year, but the market normally does end higher in that year. So again, to not get caught up on every single bit of volatility that happens within the stock market, but to keep perspective on these are normal fluctuations that do happen. And then it doesn't mean that's where your year is going to end. So, this is a really good chart, again, to kind of keep that perspective. So behaviorally with investing, it is incredibly important to resist emotional decisions. Volatility, I know, is super tough for investors. Again, like I said, it is hard to see that value. And I say that value on paper because you actually don't realize those losses until you sell. But it's hard to see those unrealized losses on paper and just look at, log into your account and see that it's down. So that I know that volatility is tough, and it is a common impulse to sell due to those emotions. But that is normally, historically, the worst thing you can do. Markets move very quickly at the bottoms. Again, we don't know where bottoms are, but when markets reverse, the biggest days in the market come at the bottom. And so if you have sold and you're on the sidelines, and then this market turns around and goes the other direction because it got a little bit of good news, you're left behind trying to figure out how to get back in. So historically, it's very disadvantageous for long-term investors to sell due to emotions. Stock markets have historically bounced back. Obviously, like we've seen every time, every bear market, every recession, depression, great financial crisis, all these things, the market has recovered, has done really well on the other side. I don't think this is going to be the first time that doesn't happen. So it always kind of reminds me of that, my favorite Warren Buffett quote, in which he says to be fearful when others are greedy and greedy when others are fearful. To just like switch your mindset to, instead of being panicked, instead of wanting to make an emotional decision, to like, okay, like I said, if we're going to recession, where's the opportunity? Wealthy people seize opportunity in recessions. Switch to that wealthy person mindset to be looking for opportunity in a recession instead of being fearful. Again, this is just one more kind of chart to give you perspective. So this is a 90-year historical S&P 500 index chart. Okay. This was obviously the financial crisis. That was a big drop and very terrible time that does cause a lot of people some PTSD when they see when they remember how that felt and seeing that happen. And it was, and I don't like diminish that. It was very hard. It was a scary thing to watch when your funds are going down 50%, and can you retire? But it's important to keep perspective on the long run, that the answer is never to just sell because, sell everything and hide, because over time, though there are these things, these are normal and they happen, the market is continually moving higher. So confident investors are educated. The more you understand markets, the more you accept and understand current market trends, and you understand that there is a season to everything, you're going to be more confident. You're going to be more cool and collected when these markets are happening. If that's not how you feel, then I would highly encourage you to continue to seek more education and things you don't understand, and get that, learn those things that you don't understand, get more educated. So, webinars, Do your research on specific items that you're kind of hung up on, and continue to learn and grow as you understand more things that should kind of give you more confidence in your investing. If you don't work with an advisor, then work with an advisor. Have a professional on your team that you can call when you get nervous and have them talk you off the ledge. Part of my job, a lot of my job is just as much counseling as it is actually managing money. It's making sure, to talk through those times when people are nervous, but it's also my goal to have my clients be able to sleep at night and not be panicking, so that they understand their plan. For my retirees, we do recession planning. They know they have their buckets that they're taking their income out of. They don't need to panic. So if you don't work with an advisor and you don't have a plan, I would encourage you to do that and get to a plan, because then you'll be able to stick to a plan during that time. And then experience. A seasoned investor who's gone through more market volatility and more recessions and crisis are going to be more calm. They just have experience. They know what comes on the other side. And so a way that, from my process that I want to build confidence in working with me, this is, the Selah process. And the whole goal, like I said in the beginning of Selah, is to bring confidence and organization to your finances. And this is the process that I put my clients through in order to do that. We sit down and we do a comprehensive needs analysis to begin. So I meet with the prospect and say, see, what do they have going on? Everybody has different situations. Some people are just starting out. Some people are inheriting money. Some people are trying to retire. What do they have going on and what are their needs? And really analyzing those. And then we get back together and I give you some custom solutions. And here's what your needs were. Here's how we're going to here's how I want to help meet your needs and get this organized for you. And then it's that accountability and implementation over that period of time. It's helping them with the budget or how much they need to be contributing every month to their investment accounts for their retirement. And then it's that continual refinement. So it's just continually, annually meeting and refining their plan and making sure they understand making changes, because there's always changes that happen in financial planning. Everybody's finances are always changing. People change jobs, etc. They move. And so it's just that continual refinement to, like I said, the goal is to always bring that confidence and organization to people's finances. So just for those that don't know, I go through the broker-dealer LPL Financial. And so here is a little bit more about LPL. And they are the largest independent broker-dealer in the US. They do not have any of their own proprietary products, which is why I like going through them. They're not telling me to sell any specific investments to you, to my clients. So I can give advice on actual investments that are the best for my clients rather than their proprietary products. And the ways to continue to stay in touch and continue to learn more. So like I said, if there's any questions you have on this after this webinar, after anything we went over, then please send me an email or a text. You can text that line there as well. And I'm happy to answer those questions for you and give you more information, or if you just want more references of the charts or whatever. Like I said, this was also recorded, so I can send you out the replay. The replay will also be put on YouTube. And so you see here my YouTube channel, so you can check that out. I do put a lot of videos on Instagram and Facebook and YouTube to continue to try to educate. So if you do not follow along there for more educational content. And then most recently did start a podcast as well. And today I just actually recorded an episode going, further into the interest rates and the Fed and all of that. So that's another place for you to stay in touch and keep getting information and learning, or share with others that are asking these questions as well. So all that, thank you for being on this first webinar. I hope it was educational for you. I hope you learned some new things today, and I look forward to doing it again next month. And yeah, thank you for joining.